Welcome, curious minds, to the deep dive. You know how sometimes a company's financial report can feel, well, a bit like a dense maze of numbers?
Definitely,
Yep.
especially for a well-known brand, right?
Yeah,
It's
yeah.
easy to just see the headline figures and maybe miss the real story.
Exactly. But often, beneath those initial numbers, there are these more nuanced, sometimes surprising stories. Tales of strategy, market shifts, how companies adapt. So today, we're going to try and navigate that maze for you.
Yeah.
Our mission is a deep dive into the latest Brooks Group fiscal 2025 results.
Right. And we want to go beyond what looks like maybe a simple sales decline.
Yeah, to uncover the strategic moves, the drivers, and what these numbers really tell us about this, iconic Canadian luxury brand. You might see one thing at first, but look closer.
And it tells a pretty different and actually quite fascinating story.
Okay, so let's dive in. Let's start with that initial picture, the top level figures. Fiscal year ending March 29, 2025 compared to the year before. Net sales came in around what? $178 million. That's a dip of about 4%. Compared to fiscal 2024's $185 million.
Right. And comparable store sales. So sales from stores open at least a year, they also saw a decrease, about 3.4%.
And then looking further down,
Yeah, gross profit, it was about $66 million for fiscal 25, down from roughly $74 million a year before.
okay.
And as a percentage of sales, that growth margin dropped too. It went from 39.7% down to 37.3%. That's a 240 basis point drop, or 2.4 percentage points.
And the bottom line, the net loss.
That widened quite a bit, unfortunately. It went to $12.8 million, or 0.66 per share. Compare that to a $4.6 million loss in fiscal 2024. So a significant jump there.
Okay, so those are the headline numbers. Now, before we really unpack why they shifted, maybe let's just quickly remind ourselves who exactly Burke's Group is in the Canadian market.
Good idea. Yeah, Burke's Group Inc. is, it's a huge name in Canadian luxury. They design fine jewelry, but they also operate this whole network of luxury stores selling jewelry, timepieces, gifts all across Canada.
Well, they've been around a while, right?
Oh, yeah. Founded way back in 1879. So, like, a really long history as Canada's premier luxury designer and retailer.
And their store footprint.
It's pretty extensive. They've got 17 of their own Maison Burke stores in major cities.
Uh,
But then they also run standalone boutiques for, really high-end international brands. Think Time Valley, Brinkhouse, Graff, Patek Philippe.
oh, wow.
Yeah, and Breitling, they have 4 Breitling spots, 4 European boutique locations, 2, plus Omega, Montblanc. They're really a cornerstone of luxury retail up here.
Okay, thanks. That context definitely helps.
Yeah.
So back to those numbers. We see the sales dip, the wider loss. It's easy to jump to a conclusion. But you mentioned there's like a key detail here.
Exactly. There's something crucial that really shifts the narrative. The main reason for that initial drop in net sales and comparable store sales wasn't some broad market downturn for them.
Yeah.
It was actually very specific. It was mainly because of lower sales of branded jewelry, specifically because a certain third-party jewelry brand exited 2 of their stores.
Ah, okay, so it wasn't everything declining.
Not at all. And here's where it gets really interesting. Like the real aha moment.
Yeah.
If you exclude the impact of that specific jewelry brand leaving those 2 stores, Burke's comparable store sales actually increased
Increased by how much?
by a pretty robust 6.9%.
Wow. Okay, so that completely flips the script from that negative 3.4% headline figure.
Absolutely. It just highlights how, you can't always take those top line numbers at face value. You got to dig into what's driving them.
So what was driving that positive underlying trend then, if jewelry was down because of that exit?
It was mainly driven by strong timepiece sales, watches, across their whole retail network.
Interesting. So a shift in what people were buying.
Exactly. A definite shift in the sales mix, showing real strength in that key luxury watch category.
Okay, let's dig even deeper then. So we had factors pulling sales down, but also these other things providing lift. Can you break down those pushes and pulls?
Sure. So on the downside, the big one was obviously that jewelry brand exit we talked about. There was also a hit from foreign exchange. The U.S. dollar got stronger, which hurt their gross profit percentage a bit, and also increased interest costs on their U.S. dollar debt.
Okay.
And like we said, that overall shift in sales mix away from third-party jewelry played a role in the total numbers.
But then on the flip side, what gave them that underlying 6.9% comparable growth?
Right, the positive momentum. Well, number one was that big increase in third-party branded timepiece sales. That was a major offset.
Okay, the watches.
Yeah. They also saw their average sale value go up.
Yeah.
So people were spending more per transaction, which helped make up for some of the impact from the jewelry brand exit.
Any strategic moves helping?
Definitely. They opened 2 brand new stores in fiscal 2025,
Yeah.
Thai LA store and a Burke store. Plus, they were still seeing the benefits from renovations they did the previous year in fiscal 2024 at their Chinook and Laval locations. Those investments are paying off.
Makes sense. Now, moving beyond just sales, controlling costs is always crucial, especially in retail. How did Burks do on that front?
They actually showed a pretty strong focus on cost management. Their selling, general, and administrative expenses, SG&A, they managed to cut those by $6.2 million.
That's quite a bit.
Yeah, it dropped from about $66 million down to $59.5 million. And importantly, as a percentage of their sales, SG&A also decreased. It went from 35.5% down to 33.5%, so better efficiency there.
What drove those savings?
Mostly lower occupancy costs, things like rent, that was down $2.7 million,
Okay.
partly from store closures and getting better lease terms. Marketing costs were also way down, but $2.3 million, as they did fewer big brand initiatives.
In staffing.
A smaller decrease there, about $500,000, linked to the lower overall sales volume and some headcount adjustments.
Okay, so they cut costs effectively,
Right.
but they still reported an operating loss, right? How does that work if SG&A was down so much?
Right, that's the tricky part. They reported an operating loss of $5.5 million, which is, a big swing from the $1.2 million operating income they had the year before.
So what happened?
The key thing here is that the fiscal 2025 operating loss included a pretty significant one-off charge. It was an impairment of long-lived assets, totaling $4.6 million.
Impairment. What was that related to?
It was mostly writing down the value of capitalized software costs
Yeah.
because there was a delay in getting their new ERP system fully implemented.
Ah, okay. So a specific sort of accounting charge related to that project delay, not core operations necessarily.
Exactly. It's one of those things that can really skew a single year's results. Investors often look past those one-time hits to see the underlying trend.
Got it. And what about financing costs, like interest? Did that play a role?
It did. Those costs went up by $1.7 million, hitting $9.7 million. That was mainly because they had more debt outstanding on average on their credit facility, some additional borrowing.
And the currency effect again.
Yep, that too. They had a $1.7 million foreign exchange loss on the U.S. dollar debt this year, whereas they actually had a gain on that last year. So that contributed to the higher financing costs.
They also mentioned something called adjusted EBITDA in their report. How did that look?
Right, adjusted EBITDA. It's one of those non-GAAP measures. It did decrease slightly from $10 million in fiscal 24 down to $9.2 million in fiscal 25. It just gives another angle on operational profitability, kind of smoothing out some of those non-cash or one-off items like the impairment charge.
Okay. So putting it all together, what's the view from the top? What did the CEO, Mr. Jean-Christophe Bedos, have to say about all this?
Well, he acknowledged the lower overall sales, didn't shy away from that, but he really hammered home that positive comparable store sales trend once you exclude that jewelry brand exit.
Focused on the underlying strength.
Exactly. He credited strong retail execution by his teams and the strength of their products, especially, again, those third-party timepieces. He's clearly looking at the strategic direction, not just the headline numbers.
And looking forward. Any hints about strategy or optimism there?
Yeah, he pointed to several things. Those 2 new stores they opened, the benefits still flowing from the earlier renovations.
Right.
And crucially, he mentioned their recent announcement about acquiring the European boutique watch and jewelry business. He said that all these things together are expected to, and I'm quoting roughly here, generate greater sales and contribute to improve our results.
So investing for growth.
Seems like it. And he also made sure to thank his teams for their hard work on, product and customer experience. Standard, but important.
Definitely. Now, one last thing. You mentioned non-GAAP measures like adjusted EBITDA. We see these a lot. Can you just quickly clarify what those are and why companies like Burks use them?
Sure. It's a good point. So non-GAAP measures aren't defined by the official accounting rules like US GAAP. Companies use them to give, let's say, a different perspective on their performance.
How so?
They often exclude certain things, maybe one-off costs like that impairment charge, or non-cash expenses like depreciation, things that might, cloud the picture of ongoing operations. EBITDA itself is earnings before interest, taxes, depreciation, and amortization. Adjusted EBITDA takes that even further.
So it's meant to show the core operational profitability.
Kind of, yeah. Burke says they use these measures to evaluate their own results, and they think it helps investors understand performance better. But Importantly, they always say you should look at these alongside the official gap numbers, not instead of them.
Right. And finally, companies often include warnings about future risks in these reports. What kind of challenges does Burke see on the horizon?
Yeah, they're pretty upfront in their forward-looking statements. They mention a whole range of risks that could cause actual results to differ. Things like potential slowdowns in consumer spending, always huge for luxury.
Makes sense.
Broader economic conditions, too, like inflation, maybe shifts in real estate or stock markets. Foreign exchange rates are always a factor. Their own liquidity, competition, commodity prices, borrowing costs.
And their own strategies.
Yeah, things like how well their stores perform, how their e-commerce does. It's basically their own assessment of all the things, both external and internal, that could impact them going forward.
Wow. Okay, so this deep dive really does peel back the layers, doesn't it? What looks like just a sales decline for Burke's Group. Well, it hides this really interesting story.
Absolutely. Strategic adaptation, that big pivot in focus towards timepieces, managing costs while dealing with specific events like that brand exit.
Yeah, that whole comparable store sales story changing completely once you exclude that one factor is pretty telling.
It really is.
So, thinking about the bigger picture then, what does this Burke's example maybe tell you, our listener, about the luxury retail market today? How vital is it for companies to be able to adapt their brand mix, control those costs, especially with all these external pressures?
Mhm.
And maybe what do these numbers hint about the sort of enduring, maybe even growing appeal of those really high-end timepieces in our current economy? Something to chew on.